You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
On temporary assignment to the Talking Real Money talk show, Tom Cock back with me, Don McDonald. Yeah, and he'll be gone again like any minute. So just enjoy him while you got him.
And taking a break from my vacation schedule. I do appreciate that. Yeah, I really do. Yeah. So
it's so funny because Tom will take a lot of vacations in June. He's just got like vacation time planned.
It's a couple of weeks,
which is coming up like any minute. And Don, that means Don will be all alone.
I will pre-record as many podcasts as you need. You know that.
No, you won't.
Okay.
I won't.
Okay.
I know you. You'll make me do it because your equipment doesn't work because you don't know how to work it.
I don't think you should get on the show and talk about how my equipment works or doesn't work. Frankly, I don't think it's that kind of program, nor is it appropriate.
Tom, they know how old you are, so
Exactly.
they can draw their own conclusions.
No drawing either of any
and
kind.
By the way,
if you don't mind.
I'm referring to, for all you little sensitive ears out there, I'm referring to his electronic equipment.
Yeah, please come on.
He still can't figure out how to turn. He can't get the audio on for FaceTime calls.
But I look good. That's all that matters.
Exactly.
The tie is nice.
He's always got a nice tie on.
There you go.
Hey, it's Talking Real Money time, and we haven't talked about anything financial yet, and we're already a minute and a half into the program.
Let's see if we can throw something in there.
Maybe we should talk about money. Yeah. I have an idea. Let's talk about something that we have a like-dislike relation. It's not really love-hate. It's kind of like-dislike. A product that really does serve a useful purpose, but isn't as grand, as great as a lot of people like to make it out to be. And what are we talking about? Well, we're talking about the very age-related investment vehicle that makes investing very, very simple for individuals, known as the Target Date Fund.
Yeah, and the idea here is you put the money in, someone manages it according to your age and expected date of retirement, right? I mean, so it's kind of going on a glide path. You're going to less risk as you get older because you want more stability in your portfolio. And it's a big deal, deal.
As a general rule, and this is what the generality of it, as we get older, we tend to have less tolerance for the wild swings in the market, and therefore the assumption is we want to be more conservative as we get older. And these have been a panacea for a lot of portfolios. Portfolio panacea time.
Yeah, I mean, it's instant asset allocation, right? You put it in, boom, it's all done for you. You don't have to think about it. But here's things fascinating. $4 trillion now in target date funds. Assets still climbing at somewhere around 20 to 30% a year.
Whoa.
And about 6 out of $10 that are in retirement plans are now in target date funds. So this is really where the action has been. And here's another milestone that's kind of interesting. Target date funds have been around in a fairly large way, for about 15 years. So now you can start looking at people that got into target date funds in 2010 and actually see how it's all worked out for them. And the reality is, despite our sometimes criticism of those funds and their performance and how
not really criticism, it's just the mediocrity of them.
Yeah, okay,
really.
That's a good word. They've done pretty doggone well. So we thought we'd take a little look at this. And by the way, for example, this year, when we really had a lot of volatility in the market, the S&P 500 from February 19th through April 8th was down about 19%. Right? Well, that's a lot of money to people. The Target Date 2025 fund as a category down 7.6. So that's kind of what you would hope, right? You're retired. You had about somewhere a little more than 1/3% of the loss that you had in the S&P 500. So you've done okay. And then you go back and look at the performance since 2010 as a category, right? As a category for the 2025 fund, you've made about 7% a year, which is, that nothing wrong with making 7% a year. More good news here, Don, is the fees, which we'll talk about in a minute here with some of the more popular ones. We'll talk about those in a moment. But again, generally, target date funds fees have dropped to 29 basis points. And for those of you who want to argue 0.29, again, so I know we don't like using basis points because that's an inside baseball deal. So again, for people that have started using these in 2010, it's worked out pretty well. I'll give you some numbers. You might be fascinated. Some of the it's 37 target date funds that have now been around 15 years, have 15 years of track record. Now, if we woke up today and we're going to put our money in one out of these, I think we can agree that we would pick the Vanguard Target Retirement 2025 Fund, VTTVX, which is only 8 basis points, 0.08. And
let me compare that. Let me just contrast that for a minute with a John Hancock 2025 at 0.8, not 0.08, 0.8.
Yeah. So, but let's give you a little performance there just to talk about that 15 years, because you got 15 years of performance. VTTVX annualized 7.6% a year. Now, you mentioned the Hancock. Interesting. 7.1. So it hasn't done. That's VJEAX. JLEAX. I was really close on that. That's the Hancock. And then you got American Funds, 2025 target date funds, AADTX. That's been the best performer, shockingly enough, with a 63 basis point charge, has made 8.05% a year going back 15 years. Don't know about the risk return. We'd have to get in and dive in to see what sort of volatility you had to accept to do that. And then another one of the big ones that we would not use, this is shocking to me, the Voya 2025 portfolio. I think I have this right. I looked it up. 98 basis points, 0.98 ISZSX. That's made 6.8% a year. So you can see these ones have been around for a long time. Are kind of hovering around that 7% return. That's good. We would not like you to pay any more. I think we safely say this, ever more than 0.5% for a charge for any fund, especially
half,
one of these.
And even in this day and age, half is too high. And by the way, that John Hancock fund also has a 5% commission to get into.
Oh, God, I hope you're not paying that in your retirement plan.
In addition to almost 1% per year in fees.
That's nuts.
It's legal, but it's wrong. It doesn't it just feel wrong and they know you're never going to read the prospectus to discover that you paid them a 5% commission, and they're not going to tell you up front that you're paying them a 5% commission and 1% per year.
Yeah, that's going to be somehow ignored in all of this discussion. Okay,
awful.
so but if
this industry just appalls me sometimes.
Yeah, if you're going to pick a target date fund, how do you go about doing that? Number one would be, the first part is understanding yourself around risk, not necessarily understanding yourself for what day you may retire. I'll give you a reason why, because with these target date funds, one size fits all. In other words, if you tell them I'm retiring in 2035, they just assume your risk is whatever it is for that year of retirement. I'm guessing a 2035 is probably 70% in stock, 75% in stock, 25%.
I'll look while you talk.
Yeah, and so they just think that that's the way it should be, which is problematic because many of you are going to get into investments that may be then too risky or not take enough sort of portfolio risk, right? Because they're going to assign that for you. And that's that. That troubles me.
2035 is about, that surprises. No, that's about right. 70-30.
70-30. So again, some of you are going to be comfortable with the volatility you're going to take in a 70-30. Some of you will not. And that's one of the problems with target date funds, right? Another of the problems that we've discussed, I think, on this program previously is they have a tendency to own more large U.S. companies because they're easier to own than it is owning small international value companies, for example. they have a tendency to sort of underweight that part of the portfolio, if you will.
Well, one of the reasons, though, that you're going to get a heavy underweighting of small in value is because with Vanguard, you are getting the market. So you're going to get an overweighting in the large companies because they make up the majority of the market capitalization of the market. You just don't have room. So you're not going to get that small value tilt that we'd like to see in a truly properly diversified portfolio, which is one of the reasons why it makes this a mediocre choice. Good enough.
Now, dimensional funds, which would have the FAMA French tilts in them, they do have target date funds, and I'm in one. I'm using one at work. I actually juice it up a little bit by adding some more small value to it as well. But so you can get those. Now, they would have to be available in your plan, I believe. You couldn't go to the public and buy those.
Right. That's the problem with DFA funds is you have to get them either through
unless they're an exchange-traded fund, correct.
An investment advisor, or they have to be already part of the plan. You just can't go get them on your own like you can Vanguard's funds. They would have to be ETFs. And they're not ETFs.
No, they're not ETFs. No, they're not, due to a number of factors. But just for giggles, what is the stock-to-bond ratio? Let's take a look at the Vanguard VTT. Lost the page here. The
VTTHX?
No, I think it was VTT something else. Oh, here it is, VTT VX. That's the Vanguard 2025.
25. Oh, that's the one that's now.
Yeah, so what's the stock to bond ratio on that?
50-50.
And what is the US to international ratio in terms of equities on that one?
Well, it's 29% U.S. equities and 20% international equities.
Wow, that's more than I would have thought in international. So, but probably not very much in small and not very much in value.
Oh, no,
either.
Very little small in value. Again, it's market proportional.
Correct. So our friend Paul Merriman has from time to time recommended 80% target date fund, 20% you put in a small cap value fund, so you get a little more exposure to that. Here's the one that I see often. Many times people come in the office, they have a target date fund, and they've decided to add on the S&P 500. And I've said, no, you already own the S&P 500 in a big way. Why are we going to add more? So that is a mistake that I see. I see them also adding a bond fund on a regular basis. Like what I'm balancing my portfolio, not knowing that, again, when you buy the target date fund, you get the asset allocation, you get a set it and forget it portfolio, and it goes on a glide path. That's all you need to know. By the way, there was one person that we know well in the industry that called the target date fund the biggest and most important invention since the index fund.
Disagree.
No, I know you're going to say that you
disagree. It's an ETF. ETF is the biggest, the most substantial change to the individual investor industry, literally since the invention of the mutual fund in the 30s.
What about Bitcoin? That could be the biggest.
That
change.
Is still. I got to tell you, if I'm looking at Bitcoin, I also want to make sure that before I go for it, I consider the possibility of a junket to Vegas, because I've run the numbers and I think the long-term odds may be just a little better.
And we'll go there and we'll see the Denver Broncos play the Las Vegas Raiders, and we'll put it all on our home team. That'll do it. That'll be
so
black
sad
or silver
for you. It'll be so sad
as it generally is. As you know. So back to the arguments, target date funds. Yes, in the category, if you know nothing about any of this and you don't want to know anything about it, great solution. Truly, because there's an expression that says, if you don't know anything about money, Wall Street's an expensive place to learn. And I think that is so absolutely true. Number two, you got to watch the expenses on this stuff, because that is, as you said, Don, it's outrageous that somebody like Hancock would charge almost 1% a year for the management of not a very expensive product to operate. And certainly part three would be, we'd prefer to see you use an index style like Vanguard's, right? That would offer you that would put you in all of those various asset classes, balance it out between stocks and bonds and not have to mess around with it. But I would add part 4, which I generally don't do, and that is you need to know you, because they don't care about who you are from a risk-return ratio. That's the issue with these funds. They're simply going to put you in it. That's the asset allocation. And frankly, 50-50 for somebody who's just retiring this year, that might be underweight stocks if you need more growth in your portfolio over the long haul, right? I mean, we don't know that.
Absolutely. Yeah. And something interesting, I looked at that John Hancock fund, and, the 5% load and the almost 1% expense ratio, there's only one way that their performance can be comparable to Vanguard's, and it is close. It's not, Vanguard's is better for the same maturity, but the reason is they take more risk.
I was just going to say, right.
They take more risk. For example, Vanguard has no emerging markets debt. None. John Hancock has 5% of the portfolio in emerging markets debt,
which is risky
to boost that yield. Yep. So they're taking a higher risk with your money. They are in riskier assets, and you can see it in the portfolio breakdown. Vanguard's is far more conservative, and it's always a trade-off. Higher return almost always means taking higher risk, and when you charge a lot, the only way to overcome the drag of those costs is to take more risk or get luckier, but we don't know how to make yourself lucky.
Yeah, you don't latch on to a football team that was good 40 years ago. That's how you get unlucky.
Wow, you are really obsessed with the Raiders right now.
I brought them up. I shouldn't.
I know you brought them up. I didn't bring them up.
Dumb, I know.
What
was
were you
waiting
thinking?
for you to do that. All right, let's go to a couple questions. This one comes from Michael in beautiful Raleigh, North Carolina. I have 2 daughters, aged 28 and 30, both single. They have about $50,000 in Roth IRAs at Vanguard in the S&P Index Mutual Fund, VFIAX. Yes, we're very familiar with that. Mm-hmm. They're maxing their Roth contribution each year. That is awesome. This is the only retirement vehicle available to them. Is it okay to leave the money in a single fund, or what fund would you recommend to diversify, and what percentages? Also, should they switch to an ETF? Don, Roth IRAs, young people, what should they put it in?
What? He just said it was the only option.
No, this is the only one. This is the only retirement vehicle available. The Roth IRA is the only place they can save.
Roth. I thought it was some sort of a Roth at work or something.
No.
Okay, no. Then no, better. There's all kinds of better stuff out there. All kinds. I mean, you're basically in the large company U.S. stocks.
Yep.
With the bulk of your money, and I really do mean the bulk of your money just first, let me look at the portfolio right now. See, 7% in Apple, 6% in Microsoft, 6% in NVIDIA, 4% in Amazon, 3% in Meta.
That sounds like around 20% or something.
Yeah, already. And that doesn't, then we throw in Alphabet, which another 4%. And Berkshire Hathaway. You own a few companies in a very big way, and you're missing all the little ones, which when you're young, all the little ones are where the cool action's likely to happen down the road, long term. At least they should be in a VT or
we'd prefer an AVGE
or a DFAW.
That's right, because you're going to get more small, more value, et cetera, et cetera. So if I was advising them, I would take them to one of those two, AVGE or DFAW, global, small value, tilt, et cetera, et cetera. So, but wow, that's great that they're saving in their 20s.
Let's see, which one's cheaper these days? DFAW is 0.25.
Yeah, and AVGE, I think, is less than that.
Let me look. 0.23. These guys are competing.
Yeah. Wake up in the morning. Wait, I'm going to take another basis point off that one. How about that, huh? Yeah,
they are battling. Let's see. AVGE has $500 million, and DFAW, I bet it has more. Let's see.
It should have more because it's a bigger fund family, but you never know.
About $700 million. Yeah.
There you go. So, but still pretty small funds.
Pretty small, yeah.
Scheme of things.
I just let's compare that with VT, shall we? Ready?
Oh, gosh. VT is going to be, wow.
The Vanguard Total World. Okay.
Yeah. What percentage of it? Yeah. This is like one of those little moons that's rotating around Jupiter or something, right? Yeah.
Yeah. The VT has $44 billion in it.
Yeah. Okay. You get the idea. Yeah. Because it's Vanguard and everybody knows it. So, all right. Scott writes us from Genoa, Illinois. No,
Oh.
I was hoping for Italy, but no, General, because I don't
You got
know.
an I.
I don't know Italian.
Give me
so-
an I.
Exactly.
Give me a T. No, give me an L.
And Scott's got a sense of humor. He writes, "Hi, Ron and John."
Oh, yeah,
'Cause
that's not a sense of humor.
That's funny. I like that.
God.
So
yeah, in your world of dad jokes, yes, okay,
that's hilarious.
yeah, but not in the rest of us, not in our world.
AI still believes 1 out of every 4 of my jokes funny, so AI is pretty smart because that is about the ratio.
Did you hear that recently they had to shut down the new code for ChatGPT because it was being too sycophantic?
Too sycophantic. Okay.
Yeah.
Now I'm getting worried.
Yeah,
Right, okay.
it was being.
So you're saying
it
my
was
ratio's
saying
off.
really nice things about stuff that didn't deserve it.
Getting the message loud and clear.
Loud and clear.
Hey, Ron and John.
Hey, Ron and John.
Something
Yeah,
I thought about, and it's purely hypothetical.
Oh, sure.
Say someone realizes a windfall. We'll use $1 million as an example, and has to set aside money for the taxing authorities. Let's assume one takes half, in this case, $500,000. Now, remember, half would not that you wouldn't pay that much in tax on it, but okay, sets aside for tax.
He's in Illinois, so
that's a good point. You never know. Yeah, they may come looking for you. Where does one put the money until it's time to pay the taxes? High yield savings comes to mind, but what about the FDIC insurance limits? Should one establish multiple HYSAs at multiple banks to avoid risk of loss in case of bank failure? Lastly, what's the best way to combine the funds to pay the taxing authorities? Again, trying to avoid being over the FDIC limits, which are what now? I always didn't they,
$250.
It is still $250, but that's per
$250.
account, correct?
Per account, yes. So if there are 2 of you, you could each have an account at the same institution
And that
for
would
$500,000. That would cover it.
And by the way, how many banks have failed where people didn't get their money back since 1933?
I can't think of a single one.
There's not one. Now, banks have failed, right? I mean, Washington Mutual went out of business, but Chase came in the next day, took over the deposits, and away they went. So there hasn't been one since I saw. So I think this is a silly thing, this whole, but if you really wanted to be safe, as you said, Don, by the way, you have to, speaking of trust, if you have to put half of or 250,000 in your spouse's name in a different place. I don't know. That's you could put your name in a different. You could have your name in a different account, right? I mean, just a
the other
bank.
thing you could do is a government money market. Never broken the buck.
Yeah, there you go.
Full faith and credit. The Illinois state income tax is a flat 4.95%.
So you got 4.95
plus the max federal, which is what? 37?
Yeah, I think it is 37.
So, yeah, he's getting pretty darn close.
You're right. 50 is right.
Close.
Good point. But he didn't say how the money came. So, in other words, if this was a gain, a capital gain, then you're not going to pay anywhere near that.
Max would be about 20.
Yeah. If it was income, then yes, then you would pay
If it was an inheritance, you could do a step up.
Then you would do a step up, right? So anyway, a lot to think about.
And it's too little for well, I shouldn't say that. Let's see what Illinois' inheritance tax is.
Oh, that's a good point. The great state of Washington, you get a $2 million exemption per household, I believe. So anyway, there
is no inheritance tax in Illinois.
They tax everything else, so you don't have to worry about it. So,
and that's the funny thing about taxes. When you really dig deep, you factor all of your taxes in. A low income tax state often is not a bargain. I was looking at the figures recently, and Florida's total tax rate, while we have no state income tax, was actually just a bit below California's. Just a bit.
Because you add in property taxes, sales
taxes, all
blah,
of
blah,
those
blah.
things,
Yeah,
and suddenly it looks a lot more. So you're going to get taxed no matter what.
Although I will stay in the great state of Washington, which I think has the highest or among the highest gasoline tax.
Oh, my gosh. Your gasoline is ridiculous.
But if you drive an electric vehicle here, you're not paying the gasoline tax now, are you? They haven't figured that out
electrical.
Yet. Every once in a while, you hear them talking about a per mile thing or something, but it hasn't happened as yet.
You're only partly electrical. You're not fully electrical.
No, I'm not. I wasn't saying it for me. I'm saying it for all the. It's like a third of the cars here are Teslas in the great state of Washington. So,
well, they were Teslas.
they put
it's the
Jaguar
great state of
on them now.
Yeah, exactly. They've got totally new logos.
Exactly. I think my daughter's has something like Well, I bought this before we knew about who, so something like that. So anyway,
this is funny. A pre-Doge edition.
Yeah, exact pre-Doge edition. So, hey, listen, thank you all for listening. Oh, that's your line, but I'm going to say it anyway.
I don't care. You can do it.
Okay.
I don't really
and
care.
Thank you all for calling.
You're going to be gone for half of June, so you might as well get it out of the way.
Interrupting my vacation series, but I'm doing it anyway because I've got a big heart. So thank you for that. And it's been great talking to so many of you, and keep the calls coming. There's ways to get help.
You mean call us on Saturdays at 855-935-TALK or ask questions on TalkingRealMoney.com using the Contact Us button.
And if you want individualized help, and yes, I take a lot of those discussions, you go to TalkingRealMoney.com, click on Meet an Advisor and say, I want to chat with Tom. Happy to do it.
All right. There we go. There we have it. Thanks for being there. And as always, please remember, there is only one place where almost every day somebody is looking out for you and talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?